If you drop a fib from this high, and we'll do it here. You anchor your fib to the high and you pull it down, okay? So since this is a static chart and it's not me doing it live over a chart, imagine my cursor's just like that. I'm holding it right there. I want you to take your attention to that red level right there. That's the 50% level on the Fibonacci. As I pull the fib down, I'm trying to eyeball this 50% level and line it up with the middle of the measuring gap. So I'm going to overlay this red line with this dotted line, which is half or the middle of this sell side imbalance, buy side inefficiency. So I'm going to pull it down from here, and I'm going to aim for that level right there and drop it. And it looks like this. So I pulled the fib from this high all the way down. There's where my cursor would be until the 50% of the fib anchored to that high. It stops me here because the 50% level laying over top of the consequent encroachment of this gap, that gives me the perfect measurement for measuring gaps. Okay, or it's basically like the equilibrium or grading a price swing. We can anticipate where measuring gaps are going to form if we know where the draw on liquidity is. Isn't that fascinating? Isn't that fun? How about where does the breakaway gap form? Around 20 to 30% of the implied dealing range. What's an implied dealing range? Implied dealing range is when the market was up here and you anticipate selling off. Where's it going to sell off to? Well, we wanted to see it go down below that 18th and 19th balanced price range of March. That's this red line down here. So we can take a fib and just loosely take it from the sell-off point and drop it right on the red line here, and you're going to get a general proximity where that midpoint is. But it's further refined when you actually use what? Price run in and of itself as it forms, candlestick by candlestick. So here is the upper quadrant of that implied dealing range. An implied dealing range is a price run that has not completed yet. If you're bullish or bearish, where your terminus or target is, which is this level here that was qualified and quantified inside of the Telegram channel before it reached it. So by having projections like this, we can grade our price swings, and breakaway gaps are wonderful to anticipate near the 20 to 30% of the price range that has yet to deliver, and then 50% of it. See that? Now, in and of itself, to me, I felt that that was very fascinating when I was coming up and I was seeing these types of things in my own analysis. I was like, wow, I've always seen books talk about gaps, common gaps like breakaway gaps, measuring gaps, exhaustion gaps. They're not my concepts. I didn't create them, okay? But I did come up with a concept, as I'm teaching you here, which is implied dealing ranges, and anticipating where they're going to form, where they're forming. And on top of that, you can anticipate the time they're going to form. That's going to be outside the scope of this lecture, but I will have it in volume 3 of the books that I have worked on. I know. Come on, ICT, come on. I can't put everything in a video, okay? But I will teach it, I promise you. So if we know that this is the midpoint, which qualifies and confirms this is a measuring gap, this level right here stops when we get this overlapping of the midpoint and 50% of the fib. This level here, pay attention now. Look at the bodies. See that? Isn't that beautiful? So you're telling me, seriously, this is fun. You're telling me that the buying and selling pressure just happened to form all the bodies right there, but the wicks are allowed to do the damage. What did they do? They went down just below that low I told you, that the 18th and the 19th balanced price range formed, and it went down below it by a tick, and then it came right back up to close inside of the level that is projected for a perfect measured run. So the implied dealing range came to perfect fruition, and it's confirmed with what? Look at the bodies. Stopping right where the fib qualifies, that being the measuring gap. Do that on your own chart. Mimic what you see me doing here. Okay, obviously you're probably not going to do it if you're watching it months from now or years from now. but I can't make, a solution for that. Just know that I've done it here, and you're welcome to, look around on X, and there'll probably be people sharing it too. But the bodies stop at that level. The wick goes to where I said it was going to go by one tick or two and says, that's it, we're done. So the bodies confirm that has been delivered perfectly. And the wick has told you what? The damage is done. We traded below that 18th and the 19th price action, that balanced price range of choppy range bound block of price action. We've done it here. And then we had this run above this short-term high right there. What is that? That's a shift in market structure. So we can anticipate the market doing what? Going higher if it breaks out and starts running. We see it deep dive, doesn't take out the low, but the bodies are doing what? What are they doing there? Staying in that level of that implied dealing range. Then it starts to rally. There's details in here that we're going to ferret out, but you can anticipate price doing what? Breaking this high. Now, why? 9:30, we have the opening range. The opening range is 9:30 to 10 o'clock Eastern time. Now, I know, there's a lot of folks out there that they'll say opening range, this or that. Some guys are saying, here's the first 5 minutes opening range. There's guys that say, okay, here's 15 minutes opening range. Here's this and here's that. I'm telling you, it's 30 minutes. I promise you, you're going to see why it's 30 minutes today, okay? But I want you to understand that anything outside of 30 minutes is just an opinion, and that's why you're not seeing them show what I'm going to show you today. What I'm going to show you today is going to blow your socks off. I promise you, any other time element isn't going to match up with what I'm showing you here today. And that's what I'm trying to twist the arm of the individuals that are just wanting to argue, whether it be in my own comment section or in other people's. I read it, I look at other YouTubers, and they're always, having my name in their mouth. And they're talking about how this, that, and the other thing, there's no algorithm. But they never want to put up against it. They never want to show whatever they're doing against what I'm proving live in front of almost 100,000 people that did not pay me to be in there watching me doing it. I want you to think about how the opening range of 30 minutes, what do we do with that information? Well, obviously you have to know the low of it and the high of it. And that's what I've annotated here. So by having that range defined, we start looking for first presented fair value gaps. Now, if you're an order block trader, you're going to wait for the first order block to form that's salient to your bullish or bearish stance on the session. It may be breakers. It may be a institutional order financial drill. It may be a propulsion block. It might be a volume imbalance. It might be anything that I've ever taught. That's your PD array. But I'm pushing the first presented fair value gap because it's good. It's like a silver bullet. It's like it's there. It's always going to be there. But there are some aspects to first presented fair value gap that I want to include here today. If you have a very small, and there's going to be times where you look at the individual price action of any given day and you may question, is the first fair value gap really valid, or should you use another one? And the general rules are this. Obviously, when we're looking at inside this range, from this candle's high to that candle's low, that's the actual range. But the range in time is here from 9:30 a.m. Eastern time to 10 o'clock Eastern time. So you're having to look inside that portion of time for the very first presented fair value gap or the very first PD array that you're going to employ as your model. The easiest one to spot is the fair value gap. All you have to do is narrow your focus down to the first 30 minutes because the algorithm is going to leave something there for smart money. It's coded to do that. Buying and selling pressure is not forming that. It's not a one print, single print, as you hear people try to call it. It has nothing to do with what I'm doing. Absolutely has nothing to do with it. You've never seen anybody use single prints that invert. Now there's an inversion of that first single print. It's all garbage. These people are just trying to find some way to make it look like this stuff has been in existence forever. But unfortunately, I broke the mold when they said there's nothing new under the sun. And that's the kind of stuff that makes me sound arrogant. But I'm just simply poking you all that are resisting. Just simply look at it. Because if this stuff existed somewhere else, other people will be doing that other stuff and doing things that I'm doing, showing precision that's unrivaled. Remember, if all that stuff happened and been in books and people have been learning for years, hundreds of years or whatever, why aren't they doing what I'm doing? Why aren't they showing it, proving precision? Because it doesn't exist anywhere else. And it's not pride. I'm not being arrogant here. I'm being very sincere, because I think that there's a lot of people that listen to people online that they look at as heroes, and they have an opinion that they've borrowed from someone else. They haven't done the due diligence of going through all the material that I put out. They look at all those videos on this YouTube channel and say, there ain't no way I'm going through all that stuff. If someone says that they watched all those videos and they think this is what it really is, it's a copycat of this or rebranded of that, I'm just going to take their word for it, and because I like them and they wouldn't lie to me because they're my hero. That's really what it is. And unfortunately, that's what it's like for my own community. If I come out here and said anything that wasn't really true, but I made the case that here's what it does. Here's what it does in the marketplace. It does this, it does that. And because I said it, they're going to believe it because they look up to me. And that's unfortunately the problem with social media. I want you to simply look at it yourself. Because if you're not looking at it yourself, and not just one weekend over the weekend or looking at this and looking at that and thinking, okay, I figured it out, and he's not being truthful, or it doesn't work, or it's not really there. You have to have time using it, really studying it. And I'm convinced that it doesn't need to be defended by me. I do these things because I stir up the community, the people that talk about it not being there or being valid, or that it's somebody else's stuff. Bring forth the evidence suggesting those things you're saying are true and what I'm saying is false. And they never do that. So this is for those individuals that don't have the details that say that what I'm saying isn't true or isn't true. This is my argument. You're welcome to leave it alone and just go do whatever you want to do. But you need to answer this today. If you don't think there's an algorithm, you need to swallow this big pill, because this is going to be a jagged one. Opening range, 30 minutes, 9:30 to 10 o'clock Eastern time. You're looking for the very first presented fair value gap. If the gap, as you'll see here, that's the very first one. See it? There's no other fair value gap on the 1 minute time frame forming prior to that right there. Now, would you agree that that's a very small fair value gap? It's minuscule. And it really didn't do anything, did it? Did it take price down to take a lower low out? No. So there's one strike against it. We already made the low of the day at a level we anticipated. So if we went down here, isn't it likely the market's going to go higher anyway if it rejects like it's done here? We have a shift in market structure. And then we're inside of the opening range of 9:30 Eastern time. So we're only coming back down to test that low. And it didn't even get down to the low of that 18th and the 19th balanced price range. So as I teach, the signatures are, we want to see levels fail. We want to see PD arrays fail. That's insight. You don't see anything in Wyckoff, supply and demand, or anything else out there that says we want to see certain things fail. Because all those books were written before an algorithm existed. The logic that these algorithms that are used to trade, they're highly sophisticated entry models, but the delivery of price is controlled. And they have to try to engage the price runs just like you and I do, and they may not get filled because the algorithm is doing all of the delivery. Think about it. Why didn't it go down below that low? Surely there's somebody down there, a collection of individuals that are long. If they're long, what's going to be below that low? Sell stops. Why couldn't it get down there just to go one more time? What's the logic that says, nah, it's not enough? And there wasn't enough sellers there. The selling pressure was abated and the buyers came in. There's more buyers. Why? Tell me why. Why right there? You're just going to give me an opinion. But what I'm going to show you today is not opinion. It's facts. It's time-based delivery, precision, and it repeats every single day. And that's what I'm trying to inspire in all of you, because we're going to talk about journaling at the end of this. And I want you to look for these things I'm going to show you here, and that's what you're going to journal. But without stealing the thunder of that portion of the video, let's go into this in a little bit more detail. Small little gap like that. That's the first presented fair value gap of Friday, March 21st, 2025 on NASDAQ, June delivery contract. It's a fair value gap that's a SIBI. So that means generally that would be treated as what? It trades back up into it and sell off. But that's canceled out because we reached our target. Now we have a shift in market structure here, and we didn't take out the low there. So we're inside of the 9:30 to 10 o'clock opening range. So if we take out that high, we really have what? We have a move outside of the opening range higher when it should be bullish because we've hit our target for the week and we rejected it here. So wouldn't it be favorable to see a larger fair value gap than this one that's in an opposing direction? If this is a SIBI fair value gap, in other words, it's a down close candle, this is what you'd see the opposite of, which is a BISI, buy side imbalance, sell side inefficiency. And notice the difference in contrast of its displacement. Significantly larger, isn't it? This would be your very first presented fair value gap within the context and narrative of what you have in price action here. When you see people on X, or if you were seeing the comments that are left in my videos all the time when I'm sharing executions, they'll say, why didn't you use that fair value gap? Why did you use that one? Why did you choose this one? Why did you choose that one? There are rare instances where my eyes, because they're 53 years old now, they're just not as good as they were when I was younger. And sometimes I make a mistake and I grab the wrong candle, or I'll type in the wrong time. And when I've noticed it, and other students have been gracious enough to let me know what I've done wrong and made an error referring to a very specific time, when they know what I'm talking about, they know that I'm referring to a different time. It may be the candle right before it or candle after it. It's the old man in me it's showing to the surface. And it's unfortunately what happens when you get old. My vision isn't what it used to be. And the other times when it's not like that, this is what I'm doing. I'm looking for things that have a greater displacement that is in the context of the narrative, what I think price is going to do. So this would be your first presented fair value gap because it's a larger displacement and much more significant than this little tiny thing here. Okay. Then the market trades above the opening range high. There's your breakout. We don't trade breakouts, but that's a break above it. We don't need it to close above it. The market trades down into that again, right there. What time is that occurring? At 10 o'clock. That's your silver bullet. It forms every day, folks. There's never been a day where silver bullet never formed. Now, ask your mentors, ask your educators, ask whoever is a bigwig in the industry. Tell them to come forward and say that their concept forms every single day without fail. There's a lot of them ain't going to even come close to wanting to say that, but I will, and I'll show it every single day. Every single day. My stuff doesn't stop working because it's algorithmic. It's all time-based delivery, okay? And that should already get you excited, but we ain't done yet. The market rallies again and trades into that old measuring gap now because we went above it here and we've got the narrative behind us that it's likely to trade higher now. This inefficiency that was a sell side imbalance buy side inefficiency or measuring gap, now we can treat it as an inversion fair value gap. Look at that. Look where it's forming. I mentioned on X that you would have a lot of ideas thrown at you. Here's one of them. If you have a market that's changed gears and direction, now it's bullish. If you can get above the opening range high, And if there's liquidity obvious in the charts, here, this gap over here, when it was going up to run the liquidity out, that's a buy side value, sell side inefficiency. But when the market changed gears, that turns this into what? A premium array in the form of an inversion fair value gap. The market goes down into the opening range high and the low of this inversion fair value gap. That was the measuring gap. So it's forming basically a pseudo market maker buy model. Okay, that's what it's basically forming. Bodies real close to inside that inversion fair value gap, but it hits the opening range high and then creates another fair value gap there. Trades outside of that inversion fair value gap, comes right back down again. Here you go. This is another silver bullet inside the hour of 10 o'clock. Displaces to the upside, runs the buy side here, and trades right up into the inversion fair value gap. And we don't even need that buy side taken there for that. Those are two trades right there that are beautiful. Right away, you can see that there are times when we can use the actual opening range that the algorithms are going to refer to. It's 30 minutes, folks. It's not 15 minutes. It's not 5 minutes. It's not anything above or below 30 minutes.